Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at investing in utilities, and my guest is Randy Watt, Senior Portfolio Manager for O'Neill Global Advisors. Investors wanting safety have traditionally often sought utilities as a haven that offers stable earnings in much the same way that government bonds do, especially when markets hit heavy weather. So much so that utilities, along with healthcare and consumer staples, are often labelled bond proxies for investors wanting a defensive play. It's a mixed sector covering traditional and new types of power and of course water, even if the top 10 holdings in the Spider Utility Select Sector Fund are companies primarily involved in gas and electricity. Among them, NextEra accounts for around 15% of the fund, nearly twice as much as any of the others, with a dividend yield on that fund at just over 3% currently. One challenge for investors, though, has been deciding between the bond proxies and the bonds themselves. As Treasury yields surged in the last months of 2022, utilities dropped until by the end of the first 3 months of this year, utilities were down around 8%. But with a strong double bounce since then, could they once again be attractive? Well, to help answer that question, I'm now joined by Randy Watt from O'Neill Global Advisors. Randy, many thanks for being with us on Sectors Up Close. Let's start with the basics. What are the pros and cons of investing in utilities, and is now a good time to jump in?
So we actually think this is a very good time to look at utilities, and there's really two reasons for that. The first is that we're pretty confident that we think 10-year U.S. government bond yields will peak this year. So that is starting to look much more competitive with the utility dividends. And second, we think given the Fed tightening and the slowdown in the economy, we think the S&P is going to be challenged to put up a year of strong earnings growth. In that environment, utilities, which are forecasted to grow their earnings about 5% this year and 7% next year, are going to look attractive versus the S&P. And right now, the utilities are trading at about an equivalent market multiple at the S&P. So we think you're going to have better, more stable earnings growth and a better dividend yield.
Now, presumably investors should be on the alert for the regulatory environment as well. What are your thoughts on that and the other special factors for the sector, such as the cost of finance?
It is a heavily regulated industry, so we don't expect regulation to get a lot tougher than it already is. But there is regulation moving the utilities more towards renewables. But long term, we think that's good because that should lower the cost of fuel for the utilities, and that should actually help their margin structures. For companies that have lower credit quality or have to build out a lot of new capacity, the higher financing costs could crimp their margins and their returns. In general, we prefer companies right now that are larger and more established, where the cost of capital is lower than the overall sector.
Now, the big paradigm shift for the sector is, of course, the move into clean energy. How is that playing out? Is it an opportunity or a threat for investors?
We think it's a great opportunity for the companies that can be aggressive and take advantage of that. So one of the names we really like is NextEra, which is, as you mentioned, one of the biggest utilities in the United States. They've been very aggressive in investing in renewables, both in their local markets of places like Florida, but also nationwide. And we think that's a positive, and it's going to help them generate faster growth over the long term. So it really is a stock-by-stock basis, and we really like companies that are being aggressive in investing what is going to be the next wave of this industry over the next 20 or 30 years.
And what are the other names that crop up in that context then?
We also like New Jersey Resources. This is a company that is involved with gas pipelines. Natural gas is much cleaner, obviously, than coal or oil. They're also investing in renewable projects. So we think that's a very, very interesting company. We also like Atmos, ticker ATO, which is another company that's been expanding into renewables recently.
And what about timelines? Do you see this as a short or medium-term play, or should it be looked at as more of a long-term mom-and-pop type investment?
We think it's more of a long-term mom-and-pop type investment. And in a time where investors are nervous about the U.S. economy and earnings growth for the S&P, here's a place they can invest at a market multiple and get earnings growth that we think is going to be faster than the S&P this calendar year.
Okay, Randy Watt, Senior Portfolio Manager from O'Neill Global Advisors. Many thanks for sharing your thoughts today. And that is your look at investing in utilities. I'm David Pollard, and this is Reuters.